Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Getting Started with Technical Analysis. And yes, it has been a rough last 3 weeks for the U.S. stock markets. And it's always interesting at times like these to go have a look at social media to see what people are saying in the comments area of, let's say, articles on trading or videos on trading. And what are they saying? They're saying, what do I do? Stocks are falling. When do I get out? Well, I think that there's nothing like a good market sell-off to expose the inadequacies in a trader's planned approach to a stock trade. So today, we're going to be talking about 5 ways that a trader might use stock charts to plan for when to sell a falling stock. Should be a great discussion. I'm really looking forward to it. Before we can get to that, though, let me first of all say hello to everybody that's chatting in from YouTube. Good to see Maurice and Scott, the Sim Architect, Ocean Life, Tom, Doug, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to the discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us here in the live stream. This one kicks off promptly 2 o'clock Eastern time on Tuesdays. We'd love to have you here. And I also want to give a shout out and a heads up that my very good friend Mike Fairborn is going to be hanging out in the chats in the live stream audience. He's going to be addressing any questions that I can't get to as long as they're on topic. Mike's there to pick up the slack, so thanks for being there, Mike. And Mike and I would also like to issue an invitation to you. If you're not following us on X, please do that. It's a great resource. It doesn't cost anything, and it's the best place to connect with your favorite presenters in between the live streams. All right? You can find Mike on X at Mike Fairborn CS. You can find me there at Cameron May CS. But let's get right into it. First thing that we need to do, of course, as we get into this discussion of trading, we need to pause to consider the risks associated with the trading. This is important information, so bear it in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Investing involves risks, including loss of principal. Schwab does not recommend the use of technical analysis as the sole means of investment research. And as we are talking about planning for the downside of trades, we need to bear this in mind. There is no guarantee that execution of a stop order will be at or near the stop price. And finally, any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for the day. Very basic, simple agenda. We're going to bring up some charts. We're going to set up hypothetical trade scenarios. We're going to talk through 5 different ways that a trader might plan for the downside of the trade. We're planning for maybe the next time the market decides to correct. All right? Yeah. So different approaches for different folks is what I almost said there. But in any case, keep your eye out for what seems to make sense to you, because there are a number of different ways that this might be approached. But let's go right to Thinkorswim. This is the Thinkorswim desktop software platform. And our first stock today that we're going to be using as an example is McKesson. You know, markets have been getting bumped around, but there are some stocks out there that are still showing some strength. And McKesson is among those, off its recent highs a little bit, but recovering apparently nicely today. And let's say that our hypothetical trader has decided, well, this looks good. Let's buy this because I think it's going to go up. But there's always the possibility that the price might start going down again. So where might a trader decide to draw that line in the sand so they're not caught off guard the next time the markets or a stock start to go in a direction that wasn't expected? Well, for some traders, they do employ charts for making those decisions. And so let's talk through the first way that a trader might make the decision for where to draw that line in the sand. How far do we allow the stock price to fall before pulling the plug on a trade? Now, for some, they prefer to bring their own expertise, their own experience, their own discretion to this decision, and they may look for what we call support levels. So what is support? Well, when they're looking at that chart, they're trying to identify recent price floors. The concept here being if those price floors are broken, particularly to a substantial extent, however one qualifies that, maybe this trade isn't going the way that we thought it was going to. Maybe it's time to withdraw from the position, okay? So I have a request here of my live audience today with over 100 people watching. Look at this chart, those of you who feel comfortable with the concept of support or price floors, and tell me, where do you think a recent price floor is? I think it'll be interesting to see what the observations are here. So as you're chatting in those comments, I'm going to start to talk through the logic of how a trader might make that decision, and then we're going to take a look at what people have contributed in the live chat. See if there seems to be a consensus, or more likely, a difference of opinion here. Okay. So one way that a trader might look for price floors is to look at where have prices risen to in the past and then sold off to. And has that recently an old price ceiling acted as a new price floor? And it's interesting to me that right here we had a cyclical peak on June 25th, right around $612. I'm going to round that off for convenience purposes to $610. But it's interesting that these previous highs turned out to be pretty fair as recent lows. Now, those are very, very recent lows. So time will tell if those hold, if that holds as a new price floor. But one common approach is to look at those previous highs, and sometimes those will act as new lows, like we saw fairly similarly here and back here. But Sim Architect, oh, that's interesting. Sim Architect says 610. That was the very first chat. That's interesting. Happens to be right where I identified an apparent one. Sandeep, though, is looking maybe down here. Could an argument be made that, well, prices pulled down to an apparent floor all the way from the fourth week of June into like the third or fourth week of July? Prices just didn't seem to want to go below 580. So if prices sag down below that level again, a trader who was thinking that price is going up and now they're breaking down through price floors, well, maybe they might be forced to admit I was wrong. Time to get out. Yeah. But this is the technique of applying one's own discretion to a chart. And there might even still be others who look at an upward slope to a trend line connecting these cyclical lows. Either we might draw in a line, or we might just visualize that line. But in this case, you can see how McKesson seems to be rising along an apparent ramp, touching off that ramp and rising again. So coming back down, touching that ramp again might be of no real technical consequence to some, but breaking through that, maybe it's time to pull the plug on the trade again. So there are a few ways, even within this first discipline of identifying when to sell a falling stock, there are a few ways that it might be approached, and certainly some discretion that might be applied. Okay, but if one feels comfortable doing that, maybe they do it that way. So that is approach number one. Now there are others though for whom they prefer to automate things. They're willing to surrender some of their own discretion in favor of automation, in favor of a more mechanical approach to identifying price floors. So I'm going to right click on one of our drawings, and let's clear off that whole drawing set and make a second attempt at identifying a price floor. And one common tool, it's probably the most common tool, at least that's been my observation in more than 20 years of doing this, is something known as a moving average. So I'm going to come up here to my little flask icon. I'm going to click on Edit Studies, and let's add a simple moving average to our chart. So I'm going to highlight simple moving average. I could have gone just down in alphabetical order, or we can do a keyword search and find it. But let's add that to our chart. And by default, this would use 9 days worth of data. I am going to extend that out to 50 days worth of data. Look at a little bit longer term time frame here. So let's click on the little gear icon, and let's change the default 9 to 50. And I'll explain what that is. I'll summarize it just briefly. But let's click OK and click Apply. And then as I click OK again, you'll see that we're left with this green line. And this line, for some, may act as sort of an automated approach to identifying price floors. So what is the line? Well, very simply, it takes the period of time that we selected. In this case, we chose 50, and on a daily chart, that's 50 days. And it's looking back over the last 50 days and calculating for us what the average closing price of, in this case, McKesson was over those last 50 days. And I can see right now, average closing price right around $590. Okay, $589.78 to be more precise. Now, what a trader might do from that point, once we've identified that average, is as long as prices remain above average, that may be a sign of technical strength remaining within the stock. Sometimes, yes, there may be some selling that takes us down close to average, but the concept there is that as prices come down, that should be more appealing to a new set of buyers who are maybe waiting to get in at more average prices, over a given time span. So there's an assumed or assumption, sort of a natural ebb and flow to price. Sure, price runs up, price pulls back a bit. What if it pulls back, quote unquote, too far? What if it's more than just profit taking? What if there are no new buyers coming in at or around average levels and price starts to go down below average? That may be to some a sign that it's time to get out. Okay. So whether one is identifying support levels manually or automating the process, what a trader will commonly do is look at some distance just below that support level. So let's say that we have our support at 589.78. Well, maybe the trader might say, well, let me give it a little bit of wiggle room below that, because sometimes price comes down to average. It slips a little bit below average and then rallies, slips a little bit below average and then rallies. So I don't want to necessarily get out just because it's poked its nose slightly below average. But if it starts to go well below average, and the definition of that can vary from one trade to the next, but maybe we pull the plug on the trade. So maybe we go, a few dollars below that's the identified support level, maybe a percentage point or 2 or 3 below that level, but ultimately the trader is just drawing that line in the sand. So how about for this example, with the support at or around 590, what if we gave it a couple of percentage points and maybe went with a sell order around 580? Okay. Sagauer says, is there a rule of thumb of how to select the length of the moving average? Yes, that's a great question, and there can be. Yeah, for some traders, they tailor the length of the preferred moving average to how long they want their typical trade to last. Typically speaking, the shorter the moving average, in other words, the smaller the number that's used. So, like we went from 9 to 50 in this example. We went to a larger number, which makes it a longer term moving average than a 9. But a shorter term moving average will typically give faster and more sell signals, as well as buy signals if the moving average is being used that way. So if a trader starts to use a moving average and they notice, wow, this seems to be getting me out just too frequently, too soon, maybe they use a larger number, slow that moving average down. That's a general rule of thumb. Okay. All right, but yes, a simple moving average is a second potential technique. Now, you can see right now that moving average value is around 590. If we were to look back, the end of last year, prices were lower. So average prices were lower. So this average value changes over time. It moves. It's a moving average. So that's how we wind up with this line over time. And you can see how it might be used to identify potential support levels. And a trader might use that for drawing that line in the sand. So if the market starts selling off or the stock gets its own mind to go down, regardless of the markets are doing, at least the trader has a plan for where to take those losses. And hopefully the losses don't mount to be too substantial, right? Okay, so that is a second potential approach. Now, the third approach that I wanted to take is addressing a potential issue here with using just, discretion or even an automated system. The problem is, even this is not necessarily tailored to the stock's specific behaviors. So for example, I said here, what if we went 2% below support, right? Or let's say the trader decided to go $5 or $10 or whatever. Well, going a fixed dollar amount or a fixed percentage amount from one stock to the next, it might be fine for one stock. It may be too tight for a second stock, and it may be too loose for a third stock. And it all relates to how much the stock tends to move on an average daily basis. A $1 below a support stop for a comparatively stable stock might be fine. But for one that moves around quite a bit, it may expose that trader to an elevated risk that they just get whipped out of the trade and off the stock goes and leaves them behind on the curb, right? So how might a trader tailor their exit plan approach to the inherent volatility or the historically inherent volatility of a stock? Well, here is a tool. Let me remove this little line representing our hypothetical stop. Let me clear that one drawing. And I'm going to go up to our little flask icon. And I'm going to use, what is this? 1, 2, 3, 4, 5, 6, 7. Currently 7 positions down in this huge list of studies is something called an ATR. Now, how many of you out there have used an ATR in the planning of a downside exit on a stock trade? And it couldn't be a paper trade. You don't have to tell me anything about your real accounts if you don't feel comfortable. But this is a commonly used indicator for the planning of a stock trade that tailors the exit to what has been the volatility of the stock historically. So an ATR stands for average true range, ATR. Now, I might call it, I've said before, I'd call it the average trading range. Average true range, fine. But let's add that to our chart. And you'll notice this is going to be shown as a lower study. It's going to be shown below the price chart. And the number 14 is going to definitely play an important role here. But let's click Apply and click OK. And now we have a second line down below our chart. And it's this purple oscillating line with a value over here. And our current value, as we look at this, if you look up at the purple value here, you can see that is 11.29. So what is that telling us? Well, you'll remember the number 14. What this indicator is doing is it's looking back over the last 14 days and it's calculating how much the stock has tended to move over a 24-hour period. It's pretty simple. Let me zoom in on price so I can sort of illustrate what's going on with this. So this indicator, it looks over the last 14 days. It starts at a closing price. So let's use this white candle right here. So it closed right here at the top of the body of the candle. And it just looks at how far the stock either moved up or down the next day. What was the biggest move? Actually, that one's going to be a little bit harder to see. Let's clear this drawing set. And how about we look here? So here's the closing price of the next day's candle. And it's looking back, it's looking over the next day and saying, well, was the high a bigger move or the low a bigger move? Yeah, this is looking down to the low in this case, but basically it's just seeing how far was the greatest extent the stock traveled over that 24-hour period. And then it just gets an average of those moves. How far is the stock tending to move on an average 24 rolling daily basis? And right now, this stock on an average 24-hour period has moved about $11.29. Okay? So imagine that our trader isn't aware of this, the 11.29, and they decide, and I'll exaggerate things just to make this obvious. Okay, let me clear that drawing set. Let's say our trader thinks, ooh, stock is going up, but I want to be cautious, so I'm going to buy it right now, and then I'm going to put a stop in $1 below my entry price. Okay, even my drawing here is actually more like $4 or $5. But let's just say our trader here hypothetically puts in a stop $1 below the entry. Well, if this stock on average moves $11 just on an average day, just moving around, what's the likelihood that this trader is going to be able to hang on to this trade for very long? I think you can see the danger here. It's very likely they're just going to get whipped out of the trade. So this ATR can be very important to some in gauging how much wiggle room they're providing the stock, and it's tailored to that stock based on its own 14-day volatility. Okay. Now, some actually go an additional step, and they might look at support. Now, okay, let me just say it this way. For some, they might just do this. Let me just remove that drawing. They might say, well, if I'm buying right here at $625, maybe I want to give it at least $11.29. At least one day. My timing might not be perfect. If I'm off by a day, I don't want to just get whipped out here. So let me give it an average day of wiggle room, or maybe 2 average days of wiggle room. Instead of $11.29, maybe they give it $22.58, twice as much, right? Or do multiples like that. So you'll commonly hear traders say, oh, I put my stop 2 ATRs below my entry, or 3 ATRs below their entry. What are they saying? Well, they're just looking at the average not candle size, sorry, the average movement over a 24-hour period, and putting their stop a multiple of that value below their entry. Now, I was going to say there's another way that some traders approach this ATR. They still employ their support, but then they'll place their stop a given number of ATRs below that support. So, for example, with the stock trading at 589, they might say, well, my ATR is 1129, so maybe I'll put my stop down around, let's say, 578, 1 ATR below that support. That's going to be down around here again. So they're not only allowing for the volatility just purely numerically, but they're also using this charting technique for identifying price floor and then giving it some wiggle room beyond that. Okay? So that is a third way. Obviously, this is it's a little bit more complicated, but that's a third way for some traders to place their stops. Okay, let's clear up our chart again. Let's remove that drawing. Let's come up here. I'm even going to take off the 50-period moving average and the ATR. Now, there are others who will use one of the drawing tools here for the planning, not only of the entry of the trade, but also the exit of the trade. And this is typically employed when a trader sees a very strong move on the stock, like we see here on McKesson, from this low to this high. Look at the distance that was traveled here. We went from $570 to about $600, close to $640. That's almost a $70 move. We'll call it a $65 move. That's a big swing, more than 10% on that stock. And when a stock races up like that, for some traders, they expect, okay, it's very likely some people will take some profits and drive the price back down again. But if they give back more than half of the territory that was gained on the upswing, that might mean that there's a bearish shift in momentum. Maybe I don't want to be in this trade after all. And they'll employ a tool for the planning of this stop. Let me right-click on this and remove that drawing. We're going to use something called a Fibonacci retracement. Now, Fibonacci's are a whole study unto themselves, and I've actually covered these in detail, dedicated an entire 45-minute discussion to how they're built and how they might be used. But let me just click on our little percentage icon here, and I'm going to go to the top of an up move, and this is commonly what a trader might do. Go to the top of an up move and click once, go to the bottom of that up move and click again. And if they're buying a stock that's been going up and they think that it's likely to continue higher, they recognize that there can be an ebb and a flow, a cyclical sort of stair-stepping higher behavior in price, and they'll plan for that. But if the price runs up and then it falls back more than 50%, this wasn't in the plan. They might start to worry about the trend itself. So drawing that fib, drawing from high to low, the fib, among other things, can help to potentially identify price floors. And that 50% one does tend to carry a significant amount of weight among Fibonacci traders. Not everybody sees it this way. But yeah, they may have a plan. Hey, if this gets down below 50, maybe $1, maybe a percentage point, maybe an ATR, however one wants to qualify that, but below 50, they might draw that line in the sand. Okay? So, that technique might be applied just about any time the trader sees a really strong move in a stock. Even this comparatively smaller move right there, you can see we raced up and pulled back. If we had a stop down below that 50% line, Let me pull this up a little bit so you can see the 50. There we are. Well, maybe that trader was still in that position. Okay, so that is a fourth way that a trader might plan for exiting a trade on a stock when it's falling. It's going the wrong direction. Now, a final way that I want to discuss, I said that we're going to talk about 5 ways that charts might be used to plan for when to get out of stocks that are falling. This is actually a departure from that statement. Instead of 5 ways to use charts, the 5th way completely ignores the chart after entry. I get questions all the time, Cameron, what about trail stops? Let's talk about trail stops, because this is another way that some traders plan the exit of a trade that's going the wrong direction. So let me just adjust my chart here again. And I will say this is also one of those stops that's probably more commonly applied when a stock is really blasting off. When a stock is going up very quickly, it can come down very quickly, and it can be a bit of a headache to be managing trades manually, looking for new support levels, even using ATR calculations or moving averages or Fibonacci's. Requires a trader to dedicate some time to reassessing the chart as it's running up and maybe adjusting their stops along the way. So a trail stop is a sell order that automatically adjusts itself. Sounds cool, but there are pros and cons. As always, with just about anything we do with trading, there are potential rewards and potential risks to an approach. But a trail stop is an order type that is used that is designed to just automatically move our stop level up if price goes up with it. Okay? So for example, let's say that our trader is buying because they think the stock is going to go higher. Right now, the stock's at 625. And let's say they've just looked at, that 610 level. I'm going to make this as simple as I can. Maybe they saw that 610 level right about here. And they thought, if we got down below that, let's say down to 600, maybe I want to be out of this trade. Well, 600 is about $25 below the current price. So what they might choose to do is go place their order. Let's say that we already own those shares and we want to put a stop in place on those shares. So let's build a sell order. I'm going to click on the bid price. Let's say that we have, a little bit pricier stock here. We have 10 shares. And I'm going to choose what's known as a trail stop. Now, what this order type allows us to do is put in a specific dollar amount below our initial entry price. That's where we want our stop to be. So if I were to set my trail stop at a minus 25 here, what we're saying is, hey, if this price falls $25, and you can see that would right now it would take us down to about $600. That would sell us out of the shares. Now, if the price goes up, that sell order trails up, remaining $25 below the highest price since we entered that trade. So let's say we enter the trade and the stock runs on up to $650. Where would our trail stop now be? Well, it'd be $25 below 650. It would now be up at 625. Now we'd be at break even, basically. And if the price were to slip back, it would trigger a sell order and the shares would be sold. Well, that sounds really cool. Now, if the stock goes up and up and up, our trail stop is moving up along with it. And as long as it never comes down more than $25, we're just sort of locking in those gains, right? I put that in air quotes because a strong gap down could still cause more than a $25 setback. Okay? That sounds cool. What's a possible issue with it? Well, it's not looking at our charts at all. Notice I'm not even displaying the charts as we discuss this. It's possible that the trail stop could move up just above a support level. Price falls, trips the trader out of the trade, hits the support, and then continues going higher. That's a possibility. This is an exit plan that does ignore any new chart developments from the time the trade is placed. Okay. Sim Architect, you're wondering about the exact mechanic of trail stops. That's how they work. Okay. So obviously, there are a number of different ways that a trader might approach the planning of the back end of the trade, planning when to exit a stock as it's falling. With each of these, they are typically implemented with stop orders, sell orders to stop the bleeding, get me out. Stop order is not a guarantee that we'll sell at a specific price. We have to remember that. But any of these plans, well, with each of these approaches, they might suit one trader's preferred approach to their trading. Another might suit another trader better. Am I trying to present any one of these as better than the other, or as suitable for your portfolio? I'm not saying that, but I just wanted to introduce how might a trader actually have a plan just in case things don't go according to what's expected. Right? So we've done it, guys. We've looked through 5 different ways to plan for the downside. We've looked at some example charts. We even walked through the placement of a trade. Okay, so this is what we do on Tuesdays. I hope that you would continue to join me on future Tuesdays. I also do want to suggest to you, if you're not following Mike or me on X, please do that. At Mike Fairborn CS, at Cameron May CS. That's a great resource, doesn't cost anything. If you haven't subscribed to our YouTube channel, go click on that YouTube subscribe button right now. That YouTube is the best place to find our playlists of previous webcast series. But it is time for me to let you go. Thank you to everybody that's already dropped a like on the live stream. I can see now 137 people watching. 33 people have clicked the like button already. That's very much appreciated. It helps. It lets me know that things are going well, and it also helps us in the YouTube algorithm. So definitely appreciate it. Speak Truth, you're welcome. Deborah, glad you enjoyed it. I will see everybody next Tuesday. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.